Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching Markets with Santo and CJ, and we have a lot to digest from the Fed to the MPC meeting. There's a lot going on in the macroeconomic, arena at this point of time. But Santo, let's put the Fed in the spotlight first, right? Yesterday, heading into the meeting, everybody was a little expectant that probably, this would be the last of the big, staggering rate hikes of 75 basis points that we have been seeing from the Fed. And although there was indication from Powell that probably, yes, the quantum of the rate hike might, trim down going ahead. Maybe it will be a 50 basis point, maybe it will be 25 basis point, depending on how data will come in. But the market's big bet that the Fed will probably now start, giving out signals that, yes, it has had enough of the rate hikes and it is now time to probably slow down on rate hike, maybe pause for a little while, see what is the impact of the actions that we have taken so far on the economy, and then judge whether we require more rate hikes or do we need to cut rates. That theory clearly is now out of the window, because Powell has said, and almost reminiscent of, back in 2021 when he was talking about, when a market was telling him, you should hike rates, you should hike rates, and he was telling people that we are not even thinking about raising rates, right? In similar vein, he ended up saying that we are not thinking about interest rate cuts or any sort of pause at this point of time. And I think that is why we saw the sort of adverse reaction we saw in the market. But the market still remains defiant. If you look at, the bets that traders are taking, they are still very much in the loop that the Fed will cut rates come July, September of next year.
Wishful thinking there. But anyway, I mean, that's a different point. It's not surprising that the Fed has indicated that it will slightly slow down the pace of rate hikes. Obviously, you just can't keep on hiking rates by 75 basis points, time after time. After all, you also have to wait for the rate hikes to have some effect, and that always follows with a lag effect. So
absolutely,
that is pretty much on expected lines. Now, what the market was expecting in terms of the pause on
the
rate,
pivot,
so-called pivot, which it's been talking about for a long time now. Fed is absolutely right there. It can't create any fertile ground for market exuberance. That is what seems to be happening. Okay. The more the market gets exuberant, the more it defeats the Fed's cause, and the Fed then has to take even stronger dose, right? So, but there is a problem here, for India also. If at this rate, rates continue to go up globally, at some point India may outperform. But if you look at the returns in absolute terms, that may not be much. Already we are having valuations quite expensive. People are talking about it, in fact, and that is reflecting in the form of slight EPS and EBITDA tweaks to most of the earnings that have come in.
Even if you look at it the past 1 year, if my portfolio is down 5%, it really doesn't matter if my neighbor's portfolio is down 25%,
exactly,
right? What will I do with that? लोग कहेंगे मैं अचार डालूं क्या कि मेरा portfolio 5% डाउन है और पड़ोसी का 25%.
That is one, and also let's not forget that the more Fed keeps hiking rates, which it has said that even if it is smaller rate hikes, there will be rate hikes, and that means the dollar is only going to get stronger, and stronger dollar means that our currency is going to get weaker. And we've already seen the problems over the last month when the RBI had to kind of intervene in the forex market. So I think at this point in time, probably we may still see the Indian markets holding up. I don't see any reason for a sharp sell-off unless things go bad dramatically globally. But at the same time, in absolute terms, the kind of returns that we'd be looking at, I think that might come down a little bit.
Well, Santo, I'll just differ a little bit here in the sense that I also feel that the market would be able to weather this Fed storm if it becomes a storm at this point of time. Of course, if you look at the US markets yesterday, they did indicate the sort of crash we saw in S&P and even a technology shock that it did indicate that the market sort of had one more reversal in its opinion onto what the Fed will do going ahead. But that said, in India, the larger story, more than the interest rate hikes from the RBI, is at this point of time the strength in the overall corporate earnings expectations. Yes, the September quarter, if you look at it on a year-on-year basis, profit growth has been largely quite muted. If you look at some of the companies, almost 700 companies who have reported earnings so far, year-on-year growth in profit is only about 2% at this point of time, despite all the margin pressure and all the cost pressure. So I think India earnings growth story is still holding up, and I think that is one of the reasons why you will see a lot of smart investors utilizing any sort of near-term dip in the market to bargain hunt, because they, at this point of time, the buying on dip strategy again has started to work and give investors return. You can see that in the past few downticks that we have seen in the market throughout this year. the 3 times that we fell almost 10%, we ended up recovering almost all of those losses very quickly. So I think from an India perspective, probably this may not be as much of a dampener of sentiment in the medium term, maybe in the 12 to 18 months. But yes, maybe going ahead to the year end, there is a possibility that this could just cap upside, or maybe put a spanner in the works of our effort to reclaim the record highs that everybody has been talking about could happen by the end of this year.
Well, CJ, I was speaking to somebody in the market, and the person was mentioning that this is actually a broker's market. The broker seems to be the only guy who's making money.
Absolutely.
Because if you look at from the FIS perspective, they had been selling aggressively, market really didn't go down, right? And now domestic funds, they have been buying quite aggressively, but market is not going up beyond a point.
Yeah, I mean, volatility is a friend. I mean, for a stockbroker, volatility will always be a friend because it makes people want to trade more and participate more in the market, either to buy or to sell. And either way, the broker will make a money. So therefore, your argument is totally valid, Santo. That said, let's quickly take a check on the market and how the trade setup is shaping up for today. Clearly, it's going to be a downtick day after the sort of crash that we saw on Wall Street. SGX Nifty is indicating almost a 150-point downtick for the Nifty 50 index when it opens at 9:15. Wall Street, of course, fell, although initially it did rise, but then when the Powell press conference happened, by the end of the closing bell, the indices were down almost 1.5 to 3% in the US, largely because of expectation that Fed hikes will remain out there for a longer period of time than what the market expected. If you look at the US dollar index as well, that also inched higher after the Fed outcome. So clearly, dollar index rising could be a bit of a negative for the rupee, as well as the FPI flows going ahead, Santo.
Well, and most likely we could see some temporary weakness, but still, if you take a slightly more shorter term view, the market is likely to shrug off the rate hike decision by the Fed, and once again the focus will shift to valuations now that we are past the earnings season. I think build up of short position in futures of LIC Housing Finance and Chambal Fertilizers, and the put call ratio in Canfin Homes, which has taken quite a beating over the last 1 month after the abrupt departure of its CEO. Now that has risen to 0.93%. Now what happens when the put call ratio rises sharply? It means that more puts are being bought, but at the same time, it's usually a contra indicator that the price may have bottomed out for the time being.
Possibly, yes. That's it, Santo. Let's move on to the newsmakers of the day, and the first pick on my radar today would be JK Paper. The company came out with a very strong set of numbers for the second quarter. Record quarterly revenues. Revenues soared about 72% on a year-on-year basis, with net profit rising about 174% on a year-on-year basis. And this was on the back of a very strong operating environment for the company, because if you look at paper prices, they have been quite firm throughout the past almost 12 to 18 months now. And the operating performance also was very strong. If you look at the EBITDA, the operating profit rose about 130% on a year-on-year basis. So clearly, market is going to be likely to reward very generously to the stock after those sort of numbers, Santo.
Well, Triveni Turbine is my newsmaker for this morning. Now the company has said that it will buy back close to about 5.5 million shares at 350 rupees through the tender offer. But you may not see much of a rally in the stock for two reasons. One, the stock has anyway been moving up quite sharply for quite some time now. Also, the buyback size is just about 3.75% of the free float.
Well, that said, Santo, what is your top brokerage bet of the day?
Well, it's Varun Beverages. ICICI Securities has a buy rating on the stock with a price target of 1,150. It had recently upgraded the price target. The earlier price target was about 900 rupees. Now, the second quarter numbers for Varun Beverages were quite strong. The volume growth was strong across segment. Now, Varun Beverage is a producer as well as bottler and distributor of beverages. The company will be expanding its production capacity by 20% in the year 2023, and according to ICICI Securities, the Sting, which recently launched energy drink, has got a very good response. It's now about 12% of the revenues already, and will continue to be a main driver of growth for Varun Beverages.
Well, looks good for Varun Beverages. Well, the top brokerage bet for me today is music broadcast. Prabhudas Leela came out with a report on the company after the company's Q2 earnings. They have retained a hold rating despite what seems to be a very weak set of numbers for the September quarter, and their target price is somewhere in the range of about 23 rupees. Now, the reason why they have retained the hold rating is largely because they believe that the company's earnings momentum is still in the longer term quite strong. They have high cash position, as well as they are trying to diversify their strategy in terms of reducing the role of the radio business in the overall revenue contribution and trying to get more into digital initiatives. Digital radio, of course, is one initiative. Digital content is another initiative that the company is taking. So clearly, Prabhudas Leela really likes the strategy that the company has adopted, and they feel in the longer term that will pay dividend. Apart from that, the reason why the operating performance in the second quarter was weak for music broadcast was largely because of the fact that they refused to take on advertisement revenues which were low yield. So because of that, they ended up getting lower advertisement revenues for the quarter, and that affected the performance. But PL believes that this is actually a good strategy, given that if you fill yourself up with advertisement revenues which are low yield, then that could affect your operating margin going ahead. So PL seems to be very much happy with the business strategy and the operating strategy of music broadcast at this point of time, and they believe that the FY24 earnings performance will recover after what seems to be like a very muted FY23 for the company, Santo.
And with that, let's move on to the stocks on our watch list this morning, starting with Mahindra and Mahindra Financial. The company's second quarter net profit number was slightly ahead of what most analysts were expecting, but again, that's largely because of the lower provisions that Mahindra and Mahindra Finance has made. And according to Morgan Stanley, the weaker than expected pre-provision operating profit is a negative, and also the net interest margin was down by about 89 basis points. That's quite a sharp fall on lower yields, and also because costs of fund are rising. Now, CJ, there's reason to be cautious on the stock because the RBI directive on the ban of use of third-party agents for recovering loans, that will be felt in this quarter.
Yes,
that was announced
absolutely.
closer to the end of September. We have not really seen that in the second quarter, but maybe we could feel the pinch of that in the current quarter.
Collection efficiency will probably have a little bit of impact. That the company has tried to say that they will start probably ramping up in-house collection processes, but clearly it is going to dent Q3 earnings. But also besides that, Santo, I think if you look at the overall performance from M&M Financial, clearly below street estimate. The net interest income was below street estimate. The net profit number was also below market's expectation. Also, margin pressure is something that will continue to remain a reality for a lot of NBFCs, including Mahindra Finance, largely because cost of borrowing is rising in the economy. If you look at the corporate bond market, borrowing costs there have inched up anywhere between 300 to 400 basis points over the past 5 to 6 months. So clearly, because of that, profitability will remain under pressure, even if you see very strong disbursement numbers or loan growth numbers from a company like M&M Finance.
Well, CJ, just before we get on to the next talk, that's the whole point. There's no mistaking the fact that rates in the economy are clearly rising, and rising interest rates initially may not have any impact on the equity market, but it's always been the case that whenever interest rates continue to rise, at some point in time, money will shift from equities to fixed deposits.
Absolutely, Santo. That's it. The first stock on my radar today is MTAR Technologies. Now, everybody has been gaga over the defense pack over the past 8 to 9 months now. But I think of all the defense companies, Santo, if any stock has justified the sort of performance is MTAR Technologies. I mean, look at the revenue and net profit performance. Net profit up 30% on a year-on-year basis, sales up 38%, and the company is now confident that it will achieve the 55 to 60% growth guidance for FY23, along with EBITDA margins of in excess of 30%. So clearly a good showing there.
I'll just come back to you on that, CJ. Before that, a quick look at the markets. Nifty is down about 110 points in early trades. We're seeing selling pressure in mid cap and small caps as well. Over 1,000 stocks are down on the NSE at this point, 670 points up. Nifty Bank is down close to about 0.4%. Nifty Mid Cap is down by close to 0.3%. TCS down 1%. Infosys down about 1%. So we are seeing weakness in the tech pack. HCL Tech is down by close to about 1 point. So tech is leading the market lower.
Absolutely. I think, Santo, that is in reaction to the sort of decline we have seen in the Nasdaq 100 yesterday in last night's trading in the US. That said, if you look at sectorally, all sectoral indices on the NSE at this point of time are deep in the red territory. Nifty IT down 0.9%, Nifty Metal down 0.9%. Now, Nifty Metal's downtick has come after, China has denied rumors that there is going to be any sort of easing on the zero COVID policy. In fact, Chinese officials have been told to strictly adhere to the zero COVID policy at this point of time, at a time when cases are again on the uptick in China. So that has been a bit of a dampener for Nifty Metal after what seems like a 3 to 3.5% rally in the previous two sessions. Nifty Pharma Index also doing quite bad at this point of time, down about 0.4%. So clearly, it's been a broad-based selling across the market that we are seeing today, and it will be interesting to see if we see some bit of recovery maybe towards the closing bell, or we see the market extending its losses by the time 3:30 comes around.
Well, CJ, coming back to your point on MTAR Tech, no doubt the company is in a very good line of business, but if you look at it, this has been the biggest laggard in the defense sector. The whole of
which
this
is surprising.
Which is surprising also because you're setting store by the second quarter numbers, which has shown a quite big jump. Otherwise, if you look at the previous quarter's numbers, they've been pretty range bound. Now, a few negatives which I spotted in that. One is that the borrowings have risen quite sharply over the last couple of quarters, from about 17 crore to close to about 134 crore odd. And the other slight concern which the market may have about MTAR Tech, not necessarily that it's restricted to MTAR Tech, because the same is true of many other defense PSU defense companies as well, is that the receivables, they have remained pretty high, and also the working capital days. And
which is very natural, Santo, given that they are a B2G business. Whenever you are a business to government business, and that is probably one of the reasons. I remember, I think, I was listening to Samir Arora not so long ago, and he was saying, I stay away from B2G business because receivables are always so high, and you are not even guaranteed that you will get or recover all of the receivables when it comes to B2G businesses. So therefore, I think that will of course always be a risk as far as defense businesses are concerned. But the thing that makes MTAR different from, say, a Bharat Electronics is that not entirety of his business is dependent on defense. Only 20% of his sales come from defense. It's also involved in the space technology space, as well as oil exploration. So I think one of the reasons why MTAR got such a strong valuation after its listing was because of that space tech tag that it got. And I think one of the reasons why it has not been able to perform as well as a Bharat Electronics is because it was coming off a very high valuation base, and there has been of course correction as far as the valuation is concerned. But if you look at the earnings performance, I think its earnings performance overall since the time it has got listed has been rather strong, and it has at least delivered on the expectations that the market had.
The rocket did take off, but it seems to have come back to the earth. The high for the stock was about 2000.
It has to for refueling, It has to for refueling.
A good point there, CJ. Well, Mahindra Holidays, the next stock on my watch list now. Q2 numbers were largely in line with what market was expecting, but CJ, here's the stock where you hear people talking about Mahindra Holidays. So a lot of them have signed up for that.
But memberships,
definitely. But at the same time, that doesn't seem to be reflecting in the top line. Now, if you see for almost 5 years now, the top line has remained pretty much where it was. So I wonder what's the reason for this. There's a huge gap in at least perception about Mahindra Holidays, and also the numbers that it has actually been delivering. And I think there's also what many people have been saying is that the ones who got in early, they're pretty lucky because they were getting it at very, very competitive rate. But now the membership rates are fairly higher, they're edging higher, and this is where probably the company then could be vulnerable to competition, which is it coming largely in the form of homestays and other hotels also, which are stepping up their act slowly. Traveling has picked up in a fairly big way, and the younger generation, I mean, CJ, maybe you will be able to tell it better. Would you want to lock yourself into a timeshare agreement, or travel on the fly?
Absolutely not. I think you always want that flexibility. I mean, that optionality is the US, is that thing of this generation. We have always wanted optionality in everything we do, whether it comes to banking, whether it comes to payments, whether it comes to social media. In everywhere, we always want to have multiple options so that we can have flexibility in terms of our consumer, decision making. And also, Santo, I'm not so sure, of course, whether the membership numbers that they give, whether they are net members, inclusive of course, the cancellations that they have also had, because it is possible that membership numbers are rising, gross membership numbers are rising, but maybe it is not reflecting on a top line because there are high level of cancellation as well. So maybe, I don't know, we will have to probably dig a little deeper on that and understand why the top line of the company has not been growing. But that said, the overall performance for the second quarter was really weak, given the fact that they're coming off also on a very weak base. I mean, the July-September, although it was the post-COVID lockdown quarter, the number of people flying out and the number of people traveling was nowhere close to the sort of momentum we saw in this quarter, or at least that's what the companies indicated. So clearly this performance is very surprising, and I think going ahead market will now start getting concerned about earnings momentum because the pent-up demand can only last so long. Demand for travel is going to normalize going ahead. And if the company cannot perform in such a great environment, then what will it do when demand normalizes? So that would be the going concern for the company going ahead.
A bit of a paradox there, if you've been a Mahindra Holidays member probably over the last 13 years, you would have created some nice memories at some of their best spots. But if you've been a shareholder, the stock has delivered really very, very poor returns.
Now imagine if you're a shareholder and a member of the Mahindra Holidays.
So you don't know what to feel exactly.
Exactly. You're confused as to how to feel about
unless you've been trading in those stocks.
Absolutely, absolutely. That's it, Santo. What is your last pick?
Last pick is LIC Housing Finance. The stock is down sharp. The stock fell sharply yesterday after disappointing second quarter numbers. Now, one of the reasons for the weakness in performance was that the company has been sacrificing its yields so as to retain its high quality customers. It's not increased the interest rates for many of its customers, but at the same time it has retained its guidance of 15% growth in loan book for the rest of this year. And also the company management in an interview to CNBC TV 18 yesterday said that the third quarter would be its best.
Well, Santo, looks like, of course, I think LIC Housing Finance is on the uptick with the new, the revamp that has happened there. But that said, a lot of questions coming in from our viewers. One of the viewers, Santo Suryakanta Mahapatra, wanted to know our thoughts on Tata Motors. Now, this is a automobile stock that has gone under the radar recently. It was the talk of the town when, back in late 2020, 2021. And since then, it has gone under the radar. So, of course, there are difficulties when it comes to Tata Motors. The JLR business clearly has been suffering because of the chip shortage, but the margin picture there seems to be looking a little better in the sense that they're trying to sell more high margin cars. They do say, they have at least indicated that demand out there remains very, very strong. So the moment the chip shortage issue eases out, they will see a big uptick in production. Therefore, that should help revenue going ahead. But now that even if chip shortage were to ease off, now they're in an environment which is recessionary, especially in Europe and China, two big markets for them, as well as US as well. I mean, even if you were to discount US, Europe is almost 15 to 20% of sales, China is almost 25 to 30% of sales. Both those markets underperforming means that JLR will continue to underperform, and given that JLR is almost 80 to 85% of Tata Motors operating profit, I think the net earnings overall are going to be quite muted going ahead, Santo.
See, the market, Surya, is also looking for the company's guidance for cutting debt. And now because of the weakness in the international markets, there are some concerns whether the company will be able to achieve its target of becoming net debt.
Yeah, I mean, and that target is just around the corner because the company is guided that they will be net debt free by March of 2024. At this point of time, the gross debt number or net debt number is still pretty high. So there is, of course, a lot of skepticism as to how Tata Motors will go about that. Santo, another question coming in from Aarti R on IndusInd Bank for the short term. Now, IndusInd Bank's, I think, earnings overall performance, if you look at it, the earnings momentum for the past few quarters has been quite solid. The company has won the market's confidence when it comes to asset quality. The loan growth numbers have been almost on par with what ICICI Bank and HDFC banks of the world are doing at this point of time. So clearly, the growth momentum or the earnings momentum is in favor of IndusInd Bank. Also, what is in favor of IndusInd Bank, Santo, I feel, is valuation, because it was valued almost at a discount to ICICI Bank or HDFC Bank. I think a lot of investors have been feeling that maybe there is a valuation catch-up play here to be had, and therefore in the near term we have seen a lot of outperformance from IndusInd Bank compared to, say, an ICICI Bank or an HDFC Bank.
And one of the things going for IndusInd Bank at this point in time is that the asset quality clearly is on the mend, and the quality of improvement too has improved. Its corporate loan book was under pressure for quite some time, but there are clear improvement there also. The market somehow is not able to make up its mind on the stock, but from the look of it, at least the stock is now being treated on par with some of the other better private sector names.
Absolutely, and I think, guys, we are out of time, so we will take up the rest of your questions hopefully in the coming shows and in the coming weeks. But we can wrap it up, Santo, now?
Well, yes, and once again, thanks for sending in your queries and also the feedback. Continue to do so. We love to hear from you, and we'll try to address your queries to the best of our knowledge and time permitting.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, you know the place to be, moneycontrol.com, and you can also download our app, Moneycontrol, from the Google Play Store as well as Apple Store. We'll catch you again at 3 p.m. Till then, have a great trading day.